So I know we've been talking a lot about the loans the last few days. We've had some webinars on that. We've talked about the EIDL loan. We've talked about the PPP loan, and I know there's some clarification in the last day or so. So that's good news. And I think we were kind of like forgetting about what's happening in the markets and what's been going on with our investments, what's been going on with our portfolios. So I thought it'd be nice to have someone on that can really kind of dive deeper into some of the stuff that's going on in the markets. So I read this blog, A Wealth of Common Sense, a lot, and I love reading his messages and the posts and follow him on Twitter. So I thought, why not ask Ben Carlson to come on and just kind of talk about the markets, talk about the investment side of this whole coronavirus thing, what's going on, what's the market going to potentially look like in 6 to 12 months, 3, 4, 5 years out. So yeah, that's why I contacted Ben. So he's here with us. So Ben, thank you so much for coming on. And yeah, so we're going to dig deep into the markets today. Tell me a little bit about yourself and what do you do for Ritholtz?
Yeah, I work for Ritholtz Wealth Management, which is an RIA based in New York City. If you don't know what RIA means, that's just Registered Investment Advisor. So we're just an independent shop. There's roughly 30 employees at the firm. We manage a little over $1 billion for client assets, and that could be individuals, families, nonprofits, pensions, 401k, 403b, that type of thing. So we kind of run the gamut of what we do. I sit on the investment committee there and help come up with portfolio strategies, investment strategies for our clients, depending on their financial plan and different risk tolerance. And there's 5 of us on that committee. We also have a host of financial advisors who are more client facing and deal with clients and build them their financial plans based on their circumstances and goals and risk profile and time horizons and that sort of thing. So we're always working together with our advisors to create portfolios and plans that help clients achieve their goals. And of course, a lot of people are worried about those goals at the moment as markets be getting hit. And one of the things that we try to tell people is that when we create investment plans and financial plans, we're not going to just hope that these things don't happen. We understand that markets crash. They can and will crash, and it happens, unfortunately. So you have to build a plan of attack into your portfolio that bear markets will happen. We don't know when, and we don't know why, and we don't know the length or the magnitude, but we know they're going to happen. So you have to build portfolios and investment plans that are durable enough to see you through something like this, because unfortunately there can be severe market dislocations. Now, we would never ahead of time say, well, we're going to plan for a global pandemic where the entire economy is going to literally shut down. That's impossible for us to predict, but we know that this happens, and it has happened over time in terms of markets falling, very hard, very fast. And one of the reasons this one is so scary for so many people is because the speed in which it happened. And so we had, going back to the late 1920s, this is the fastest the stock market in the U.S. has ever fallen 30%.
Yeah.
It happened in a span of about 20 days. So it's almost hard for people to catch their breath and really take a step back, because a lot of times it actually takes much longer for stocks to get to that point. There's some give and take here, and the speed at which we've seen this, in many ways, kind of makes sense, because we're seeing a repricing of what's happening in the economy and we fell off a cliff, and a lot of these numbers that you're going to be seeing, that we already saw some today and in the coming months, are going to be just this historic drop off in the data. So
Yeah.
in some ways it makes sense. In a lot of other ways it doesn't. So we see today that there's unemployment claims from last week. There was more than 6 million people that filed for unemployment. The week before it was more than 3 million, and both of those are obviously record all-time highs. And surprisingly, the stock market has rallied on both of those days. Now, I don't know what will happen the rest of the day today, but a lot of people look at this data and say, well, I don't understand. We had this horrible economic data. The stock market should be falling and getting crushed. And especially in the short to intermediate term, the stock market really doesn't make sense in a lot of ways for that stuff. It's almost like if you see it in the news headline, the stock market has already probably thought about it or digested it. And it's not that the stock market in the short term trades on good or bad, because if it traded on good or bad news, it would be a lot easier, right? It trades on better or worse than expected, especially in the short term. In the long run, fundamentals still matter, and what happens in the economy and earnings and dividend payments and cash flows from corporations, that stuff all matters. In the short term, it's really an expectations game. And not only, what do market participants expect to happen, but what are the expectations of what the reactions are going to be to those expectations? And so it can play head games with you in terms of the stock market really not making sense during these times, and rallying when we think it should, and falling when we think it shouldn't as well. So the stock market is definitely confusing at times, and it may not make sense to people who don't follow it all the time. But the fact that people are trying to bake in expectations for the future, in a future that is very unknown at the time being, is makes it maybe even more confusing than usual.
Yeah, and a lot of people are comparing this to the Great Depression from the standpoint of how far the market's fallen. But I think it's still different in the sense that the comparison, I mean, that wasn't because of a pandemic, and the recovery was also very slow, very painful for many, many years. With this, though, do you think that because of it's a pandemic-induced collapse, when things start to go back to normal, we could potentially see a very, very narrow V-shaped kind of recovery where things, and I saw that in the China PMI data the other day, where, I mean, they had the narrowest V that I've ever seen in terms of like how quickly some of those things are rebounded. So going forward, I mean, how does that look like for the markets here in the US and even globally? I mean, right now, China is showing some strength on their side, but I also feel like some of that data, I don't know, could be manipulated or understated. Who knows?
I definitely think you always want to think in a range of outcomes, and then come up with something of a baseline. But either way, you want to think of a range of outcomes. So best case scenario would be we turn this thing on by late summer, early fall, things start to get back to normal a little bit, and we do see that V-shaped recovery. That would be great. I don't know what's going to happen. I tend to think this is the type of thing that could potentially change people's behavior, and just flipping a switch back on and turning things on could be harder to get people to do. And so in that instance, maybe we slog through a little bit and things are tougher. So it's really hard to say. So you have this range between V-shape on one end and Great Depression on the other hand, where after the Great Depression, the unemployment hit 25% in the Great Depression, and it stayed above 20% all the way through the end of the 30s. And it really wasn't until World War II that the Great Depression really went away, because the government decided to spend so much money. Now, of course, the biggest difference between that period and this period is back then the politicians and the people on the Federal Reserve were so inept that they actually made the problem worse. They were tightening monetary policy and tightening fiscal policy. In this instance, we're getting a huge fiscal rescue plan. The Fed is throwing the kitchen sink at this thing in terms of keeping the plumbing of the financial markets going. Yeah. So we do have help from policymakers, and we may need more. In some ways, that may not be enough to save some businesses and such. But I think we have much more help then. So again, it's a question of setting a baseline and understanding. I think people need to plan for a wide range of outcomes, because it's really hard to say what is going to be the lasting impacts and scars for some people. Some people may move on from this and never think about it again. Other people could have, the way that they view the world, and it could be more of a tiptoe back into things. So it's really hard to say how people are going to be impacted by this. Because when we had something like, even like 9/11, the patriotic thing to do was get out and travel and spend money. And with this situation, obviously, at the time being, we can't do that. And you wonder if people's mentalities are going to be changed because of this. I think a lot of that will really depend on how long this actually takes to play out.
Yeah, and I agree, and I think the investor psychology is also changing, people's mentality is changing, and who knows how this is going to play out. I think one of the things that I've seen is obviously in times like this, the volatility in the market increases so much to the point where people start calling bottoms, people start calling that this is a new trend. But can you talk a little bit about investor psychology from the standpoint of there's been a huge increase in retail investor over the last 10 years. So it's been so easy to, go download a TD Ameritrade app or Robinhood and start investing in that kind of stuff. But that's having some effect on the markets also, because that wasn't the case back in the 30s. That wasn't even the case back when 2008, 2009 happened. I mean, yeah, there were some apps, but people weren't really using it. Nowadays, you can carry that phone with you, pretty much throughout the day, and you can trade, do all kinds of things. But what are some of the negative consequences of that, and how do you kind of move on and kind of create a plan that's more long lasting, that's more diverse, and have less kind of divergence and volatility in your own portfolio?
Right. It's kind of a double-edged sword now. I've been saying for years that we're living in the golden age of the individual investor, because fees in many cases have effectively come down to nothing in terms of trading. The cost that it takes to put together a diversified investment portfolio could be pennies on the dollar depending on how you do it. Whereas back in the day, it would have cost you a lot of money, and you would have been calling your broker every time you wanted to do something.
Mm-hmm.
Now those barriers to entry are gone. The double-edged sword from that is it is great because individuals have almost an endless amount of choices, and sometimes that's a problem. And the fact that we've taken away some of those frictions in terms of trading makes it more tempting for people to do something. And when you trade a lot, that could not only increase your costs in terms of your taxes paid if you're trading in a taxable account, but you're increasing your odds of making a behavioral mistake. So even though fees have come down, you could eat up every fee saving you've ever made over the course of a few years with one mistimed trade if you sell out of stocks at the wrong time or buy at the wrong time. And one of the hard parts about living in a volatile market like this is when bear markets hit and people panic and markets are going down, you tend to see the biggest up days happen concurrently with the biggest down days. And that's kind of confusing for people too. When they see this 10% up day over the last couple of weeks, they say, oh my gosh, that must be it. That's a relief rally. This thing is over. The problem is when you see panic selling, you also tend to see panic buying because people really don't know what to make of the situation when stocks are falling. So when you're in a downtrend, you see these big up and big down days and people don't know what to do. And then that can make you whipsaw yourself like crazy to trading. So one of the things that we have always tried to tell clients when we build plans is that we want to make this as rules-based as possible. So we want to take the human element out of the game as much as we can. Obviously, there still have to be decisions made. You still have to figure out what your asset allocation is and what your holdings are going to be, whether you're going to use index funds or active funds or individual securities in the different types of strategies. So you have to pay attention to that stuff too and make some decision here and there. But we just decided a lot of ahead of time that we're going to make it as rules-based as can. That's going to take not only the client emotions out of the case, it's going to take our emotions out of it because we're human too. Everyone's emotions are heightened in a situation like this. And a lot of times those emotions come not just from the market, but from dealing with your own personal life or your business. And that's what's making it really hard on people these days, where they're so stressed out in other areas of their life that they could be making poor decisions with their portfolio as well. So as much as you can, if you can take the human element out of it and figure out what your weak point is in terms of your own personality or your own lesser self when making investment decisions, take that out of the game and have as many if-then statements as you can in terms of, if this happens in the market, then I'm going to do this. If this happens, then I'm going to do that. And most of the time, maybe the answer is I do nothing. I don't have to do anything, because maybe a lot of times doing nothing, if you've set a plan in place in the first place, that's the best thing to do. But anytime you can take yourself out of the equation and have it be rules-based, we find that really helps. And that way you're not just trying to put your finger in the wind and guess which way the wind's blowing and try to guess what's going to happen next in the market, because frankly, no one knows what's going to happen. And so trying to guess that stuff is just going to bring more pain than pleasure at that point.
Right. And I think, and I see messages in my group that there are people that are like, hey, I sold everything and I went into cash a few months ago and I kind of saw this coming kind of thing, to people that are like, hey, just keep buying, dollar cost averaging. And then there are people that are like, hey, look, I've got all this money saved up, and now that the market is down, 30+% from where it was a month ago, I'm going to start dumping some money in the market. So in those kind of situations, there's like 3-4 different kind of variety of people out there. What do we do in the sense of, like, when do you say, okay, you know what, from the metric standpoint, the markets are making sense to go back into the market and start investing again? But on the other hand, you see things like, I suspect that probably well over 80% of companies that come out with earnings this month are going to say, we're withdrawing the guidance going forward for now because we don't know how this is going to play out, which creates a lot of uncertainty in the markets, because you have no idea what the next 3 months, 6 months, 9 months, 12 months are going to look like for them. So at that point, what is the market going to do? Like, what is it going to trade on? What's the trade behind it at that point?
Right. The thing to remember, this is very financial textbooky in some ways, but I think it's going to help. So let's say earnings for the S&P 500, the overall market, just completely evaporate for the next year or two. People are going to say, okay, that means we're in the Great Depression. Stocks are going to go down 80 or 90% because if companies aren't making anything, what should we pay for these stocks? But the way that you think about stocks is it's discounting all cash flows going out into the future. So if we look at all dividends and profits and earnings going out well into the future, and stocks are a long-term asset, let's say 30, 40, 50 years, when you're discounting those cash flows, should there be some repricing from taking out a year's worth of earnings for there? Of course there should be, and we've already seen that, I think. Does that mean that stocks should go to zero because of that? Because for 1 or 2 years there's no earnings. It's the same thing with any business. As long as the business is not so impacted that it's going to shut down, and I don't think the U.S. stock market is going to completely shut down. If that happened, we'd have bigger problems on our hands. That's kind of the way to think about this, that these numbers are going to be just horrific and awful. But the market is this discounting mechanism where it's always kind of trying to stay one step ahead and figure out what's going to happen next. And I would never say that the market is so smart that it's going to be able to look past this, over this complete valley, and move on right away, because there's certainly still pain to come. And there's the news headlines especially are going to get far worse before they get better. But if you were trying to wait for the dust to settle, and I'm just going to wait until the unemployment numbers come back down or things start to look a little better, the stock market's going to be gone by then. And that happened in 2009. Stocks bottomed in March of 2009, took off. I think they're up 40% that first couple of months and never looked back. And unemployment didn't top tick until October of that year. So, a long time later. And so the stock market will move on before you even try to think about finding a bottom. And I think what's key for a lot of people is, if you're one of those people who does have some cash, and for either it was a smart move or a lucky move, or you just happen to hold a lot of cash and you want to put it into the market, I think the first thing to do is take out any idea of trying to call the bottom exactly. No one can do that. It's impossible. No one knows, because these things just it trade on pure emotion at that point. You're just guessing. So I think, however you put the money to work, have a plan. That could be breaking it up into 4 different chunks, or 10 chunks, or 20, or how many of you are comfortable with spreading it out over a certain time period. So you could put money in every 2 weeks or every month, or let's say you're going to buy every time stocks are down another 10%. But always have a contingency plan, because if you're banking on, I'm going to only buy when stocks are down 50% or 60% because I know another Great Depression is coming, that's possible. That's within our wide range of outcomes, but it's not a certainty. It doesn't have to happen like that. The stock market doesn't have to fall as much as it did then. So you have to have a plan of attack for, okay, I think maybe I was wrong and now stocks are going up. So I think there's always got to be a component of a rules-based guidelines to you to guide your actions, because if you're trying to guess every single day, well, stocks are down 5% today, maybe I should put in, no, they're up 3% tomorrow, I probably shouldn't. I think you just have to have rules to guide those actions, and just figure out a plan that you can stick with. And that's more important, because I think sometimes perfect is the enemy of good in these things, where people try to time it perfectly. And with stocks down 25 or 30% from their highs, and if you're buying overseas or even in small caps or some other markets, they're probably down even worse. We're going to look back in 5, 10, 20 years, and this is going to look like a wonderful buying opportunity. And no one's going to say, you know what, I missed the bottom by 10%. I think you're going to regret more not putting money to work than you are going to regret holding on to that cash. And if stocks then do take off and you get left in the dust, that's when it becomes, cash becomes this addiction where you never want to put it to work, because you always think there's going to be another leg lower. So I think I like to think in this regret minimization framework of figuring out figuring out a way to make it so, you don't have to go all in or all out all at the same time. So, break it up into chunks, make it easier, dollar cost average in, figure out a plan you can work with. Maybe say you're going to do it, once every 2, 3, 4 weeks. And if there is an opportune bucket that you want to keep out, 20% of that or so, to say, I'm going to keep this on the sidelines and invest it at the point of maximum pain, stocks are down X%, then you can do that too. But I think you just have to have some rules to guide you, or you're just going to overthink it and second guess yourself, and it's going to be painful.
Right. I agree. And I think, and that's kind of the problem right now, is that there are so many people, trying to predict when that bottom is going to be, when you start kind of going back in the market. but having a plan in place makes it a lot easier. So, as one of the things that we've seen, and I don't think it's necessarily pricing it correctly, is commodities right now with gold and silver, moving up and down, up and down. One point a few weeks ago, gold was a lot higher than it is today. Same thing with silver. I mean, some of these silver stocks have come down so much, but would you say that there should be a plan for people to invest in commodities, like through, index funds or ETFs and that kind of stuff? Or is that
commodities are tough because there are no cash flows. So I talked about how the net present value of any asset is just, you discount their future cash flows back to today. And with commodities, there are no cash flows to deal with. There's no dividends, there's no earnings. It's a hard asset. And that doesn't mean that you can't or shouldn't hold those, but I think you have to remember that these things are much more prone to boom bust cycles. And these are actually, I mean, you could make the case that gold is a hedge, and I think gold, in terms of commodities, might be one of the more unique ones in that it's probably more of a currency than a commodity and a store of value than something like oil or some of these other things. But my research has shown commodities are probably more of a tactical investment that you want to take advantage when they're in the boom and try to be out when the bust. And that would be something like a trend following strategy, which maybe is too much for this discussion. But commodities are a difficult beast because there are no cash flows. So I've always had a hard time wrapping my head around exactly what the expected returns for something like that should be. And so I look at, in terms of hedging, and obviously gold has been volatile, but has actually stood up pretty well for this. I still think in terms of diversification, your best hedge for the foreseeable future is going to be high quality treasury bonds from the U.S. government. And those have definitely, even at really, really low interest rates, and I think a lot of investors have soured on them in recent years because they realize, well, I'm earning 2-3%, and now it's probably closer to 1%. And lower than that in some cases. That still remains one of the greatest hedges because you see this flight to safety where the U.S. dollar is still the global reserve currency, and people trust the U.S. government still to pay that back, and that money, that those treasury bonds are money good, and so people have this flight to safety, and bonds have been the stabilizer here, as everything else, any type of risk asset. If you hold private businesses, those are getting slaughtered. Public equities. Anything that has an element of risk to it, even bonds in different, so corporate bonds or high yield bonds, mortgage-backed bonds, asset-backed bonds, anything that's not a U.S. Treasury has had some difficulty over the past 5 or 6 weeks. U.S. Treasuries have held up really well and been that stabilizer for your portfolio, and that's one of the benefits of diversification. It's just that you have a stabilizer and an anchor in your account that can help see you through some of these things and hopefully lower the brunt of it. So the stock market, S&P 500 was down 20% in the first quarter through the first 3 months of the year. If you had a 60-40 portfolio, you're down roughly 12%. If you have a 50-50 portfolio, you're down 10%. So bonds have done their job in terms of stabilizing the portfolio. It just depends how much you want to give up when stocks are going up, as they have over the past 10 years. So it's always going to be a give and take because risk and return are really attached at the hip.
Right. Yeah. And since we were talking about, bonds and commodities, I think there's obviously a lot of discussion about Bitcoin. And it's kind of tricky because, again, Bitcoin's kind of one of those things where it's still not widely accepted. It's been around for some time now, and there are extreme viewpoints on that. Some people are like, it's a scam. Some people say, no, this is the best thing. I've followed some of some of these posts on Twitter, even from experts that are, there's just different viewpoints on that kind of stuff. But as from an investor and as an individual investor, I mean, what would you tell your clients? If someone comes up to you and says like, hey, I was thinking about buying $10,000-$20,000 worth of Bitcoin, what would you say?
Right. We don't hold it in client portfolios because there's really no way to custody it yet safely in terms of keeping it at a third party and making sure it's a safe asset. We do tell clients, listen, if you want to take 5 or 10% of your portfolio and have a fun account and trade penny stocks or go into Bitcoin and buy crypto, have at it. If you have to scratch that itch, that's fine. We're going to have your more stable core portfolio over here. and you can have fun with some of that money if you want. And there's nothing wrong with that because it is a speculative asset. And I think a lot of people were assuming that, well, it must be non-correlated to stocks. So that means when stocks fall, Bitcoin's going to go up. And it doesn't really work like that. The correlation is probably closer to zero, meaning there's really no relationship between Bitcoin and stocks. So from a diversification perspective, it could prove to be a diversifying asset, but that doesn't mean it's not going to get hammered when stocks go down, because what has happened in the past few weeks is that the only thing that mattered for people was cash, because a lot of people just need money. So they were everything they could. So in some weeks that was Bitcoin. In some weeks that ended up being bonds. And in some weeks that was stocks. So when you need cash, and this is not just for investment purposes, this was for a lot of people, they needed cash to survive. And so they tapped their investments as something of an ATM. And so when risk goes off like it has, this happened in 2008 as well, people will sell what they can. And you see this with some of the best performing investment strategies will be used as that ATM, as a source of cash. So that's why cash is so key to make it through a crisis, and why we tell people that, again, have fun with your investments and stuff, but investing doesn't matter nearly as much as financial planning and personal finance and making it through something like this. Obviously, your investments are going to be important, and paying attention to the markets is something I do on a daily basis. I'm constantly writing about it. But if you don't have your personal finances and your financial plan all shored up, then it doesn't really matter what you invest in, because you're not going to be able to survive something like this.
And I've been a big fan of putting away, 6 to 12 months of expenses in cash. And then, some people might say that that's too much, but I think it's that peace of mind when it comes down to, if something like this were to happen, then at least you have something to kind of get you by for the next 6 to 12 months. And right now it's kind of hard because we don't know how long this is going to go on for. And then people that have small businesses, they have to worry about not just their personal finances, also their business finances. And that's a lot of us in this group, is that we're small business owners, dental practice owners. And it's been incredibly difficult to figure out what the future of that's gonna look like for us. So it's one of those things where I agree that having the right balance is the key, but figuring out that balance is even harder.
Yeah, and I think now is probably the time where you almost have to have a backup emergency plan, right? Because some people, no matter how well you plan financially, you may not have a backstop if your business is really struggling, and if this does last longer than we think. Again, it would be great if we can turn everything back on and turn the lights on and everything goes back to the way it was. But if it doesn't, and if this takes longer to process than we think, I think you need to look at backup plans. So if your emergency savings eventually is exhausted, do you have a home equity line of credit that you can tap potentially in an emergency to see you through something like this? Do you have some other form of cash that you can tap to make it through and not have to tap your investments? And that's another reason why, if you are tapping your investment portfolio and you're forced to do that, you need something like bonds or cash or something safe that you can take out of and not take your stocks, because the last thing you want to do is sell your stocks after they've already fallen 30%. At that point, you're locking in permanent losses. Right now, it's temporary, unless something has changed in the world. I'm pretty confident the stock market will come back eventually. I don't know when it'll be. I looked at this a couple weeks ago, and I said, how long has it taken historically from bull markets like this to make it back? And so there have been, I found roughly 20 to 25 bear markets, and that's a loss of 20% or worse going back to the late 1920s. And on average, it's taken about 26 months to come back from that. Now, maybe this one is faster since we went into it faster, but that's certainly no guarantee. A lot of times the pain tends to linger for these things. And so even after 2009, after the market bottomed, it took roughly 3 years to get back to breaking even when you include dividends for the S&P 500. So I think you always have to have a backup contingency plan to see you through something like this, and just in case, so you don't have to sell your stocks at the bottom. And for some people, that could mean just, if you have a relatively high savings rate, I think that's one of the biggest margins of safety you can get. Now, you would love to be able to take that savings and put it to use in the stock market right now, because you're buying at lower prices and potentially continue to buy at lower prices. But if you've created a nice personal financial situation for yourself, and you have a high margin of safety through a high savings rate, you can use that to get you through something like this, where unfortunately, if you cut back in your savings a little bit, you're not taking advantage of lower prices, but you are able to keep your household going without incurring some debt.
Yeah, and that's where it's kind of unfortunate because I know that the government's allowing, I think it's up to $100,000 that you can withdraw from your 401k penalty free. And, in essence, yet it might make sense. But unfortunately, I feel like that's kind of doing a disservice to yourself and your portfolio because now you're pulling money out at much lower valuations than just a month ago, just because you need the cash. But maybe a better idea would be to tap into a line of credit for from your house or something to get by at such lower interest rates right now.
Yeah, I would almost look at the retirement contributions in my personal view as hopefully that would be the last resort, because interest rates are really low right now. And another thing you can do now is, if you haven't in the last say 12 months, is refinance your house, because interest rates have come down quite a bit. And if you can save some money that way by refinancing, it may take a little longer now because a lot of stuff is effectively shut down. I'm going through refinance at the moment right now, and the bank has said, listen, we'll keep with the locked rate that we gave you, but it's going to take some time because they can't send housing appraisers out and that sort of thing right now. But
Right.
if you have that ability, yeah, I think especially with interest rates so low right now, and if you're in a financial position to do so, taking some, that money in your house that you can't spend your house right now, right? Effectively.
Right.
So, yeah, if you're in a bad enough position you have to take from your retirement account, some people are going to have to, but I think that will hopefully be the last resort for people.
Yeah. And then since we're talking about like the houses and that kind of stuff, do you think, in your opinion, that some of this is going to spill over into the real estate markets from the standpoint of, house markets dropping, real estate values dropping because of this uncertainty that people don't want to sell right now because they think they're going to get a lower price. People don't want to buy right now because they don't know if they're going to have a job next month or so.
I certainly think we could see almost a freezing up of it. I mean, I don't know how many people are going to want to go out to an open house in the summer with the pandemic that we're worrying about, and people having to keep some distance. So I think it's almost like the market could effectively be frozen, which is kind of what we've done to the economy. We've put it on ice in a lot of ways for hopefully not that long, but potentially a month or 2 months or 3 months or however long this lasts. So I think real estate is the kind of thing where, yeah, if you're banking on selling your home right now, that could be tough to do and because the pool of buyers is probably pretty small, and the pool of sellers, I'm sure there's a lot of people who were thinking about selling who now are pulling back and saying, well, I might as well wait till this thing passes by and people are more willing to come out and take a look at my house. So yeah, I think the real estate market is going to be tough, and that's obviously true for people who have rental properties as well. I don't know if any of the people here are in the rental property game, but that's a tough thing to deal with too, where you may have tenants who just can't pay their rent to you, and you have to figure out a way to make it through that on the cash flows from that. So I think all up and down the people are being impacted this from 12 different directions.
Right. Absolutely. And I've been reading a little bit about mutual funds versus ETFs. Like right now, I feel like there's been some news and that some of this carnage is happening because of the ETF liquidation or so. What's kind of the whole thing behind that?
Yeah, it's interesting because this is again the double-edged sword of having easy access. ETFs are typically a little bit lower cost than mutual funds, where you'll have a Vanguard or a T. Rowe Price or Fidelity. They may have a S&P 500 index fund, mutual fund, and that trades only at the end of each day, and they give you the NAV price. While the ETF may be a little lower cost, it's more tax efficient. So for a taxable account, ETFs make more sense, but it trades throughout the day. And you almost have to pay up for that liquidity in times of stress where the market could be saying, we don't think it's worth what you say it's worth. And that is definitely more true in bond fixed income ETFs than it is in stocks, where there could be some differences between what the mutual fund says it's worth and what the ETF says it's worth, because it's being priced every day. And that is almost your price of liquidity, because bonds don't trade like the stock market does. Bonds trade far more infrequently. They trade in these huge lots, and they have big bid-ask spreads. So if you're an individual trying to trade bonds, I would highly recommend not doing it, because that's just a market where if you don't have scale and size, where some of these huge bond funds are multi-hundreds of billions of dollars and trading in huge, million or $100 million lots. If you don't have that scale, you can get just eaten alive in that space. And because a lot of these bonds don't trade, it's hard to know exactly what they're worth. So a lot of people have blamed the ETF, saying, "Oh, this is the ETF. The ETFs are failing." But what I think a lot of them are actually saying is this is what the market actually thinks these bonds are worth. And maybe the mutual funds haven't quite caught up to them. So the bonds are trading every day. And maybe the ETFs are giving more of an accurate picture of what they truly are. You just have to be careful when you're trading these things that you have to understand, when it's trading at a potentially discount or a premium. So I think you have to be careful when you're trading those ETFs, and the difference between that and a mutual fund, where the mutual fund, you get the NAV at the end of the day. And with an ETF, because you're paying for that liquidity, there could be some dislocations between what the price is and what the underlying value of the holdings are. So it's a tricky thing where you better understand what you're doing when you're trading. And it's almost like going into the market right now and putting a market order out, meaning you put an order into the market, you get whatever price someone is willing to pay for it, whether it's a buy or a sell, versus a limit order where you put a price on it and you set the terms. And so you have to be really careful these days, especially when markets are so volatile, not to get taken by a bad trade when you are transacting.
Right, absolutely. And that's been, I feel like that's been kind of one of the things in the news right now, is that a lot of these hedge funds that do trade ETFs day in, day out are the ones that are kind of getting, bearing a lot of that problem right now with, what are they leveraged out, like 5-7 times their values, or?
Right. Yeah. I mean, that's a lot of the private equity companies that have been hurt, and that's one of the reasons why it hurts when you have debt going into something like this, because if you borrow a little bit of money to buy an asset and that asset goes down just a little bit in price, because of the leverage, that amplifies your losses of the investment that you made. So it can certainly amplify things. So taking on debt and leverage helps when things are going well, and then the other side of that shoe is when things aren't going well, it can be pretty painful on the other side.
Yeah, absolutely. So can you talk a little bit about investor psychology? I know you write a lot about that in your blog. What are people feeling like right now? I mean, when you get these calls from your clients, like what are people telling you?
The interesting thing right now is we're not seeing a lot of panic, and we've tried to set expectations up front for people. The interesting thing about this, more than any other crisis I've lived through, and the one big one I've lived through was the 2007 to 2009 one, is back then people were really worried about their, the financial markets, and we thought the whole financial system was going to come crumbling down around us. Today, people are more worried about other things than their portfolio. It's almost like the portfolio is secondary. Now, that doesn't mean you shouldn't worry about it, but people are obviously worried about their health and maybe their job or their business first and foremost, and then their investment portfolio. But I think once you get past that stuff and you do start drilling down into it, obviously people who it really depends on where you're at within your investment life cycle. So if you're young, you're in your 30s or 40s, you potentially have 2, 3, 4 decades, if we're counting retirement, to allow this money to grow. So these losses really sting, but you have human capital. That means you have earnings that are coming in the future at some point. Even if your business is disrupted for a while, as long as it's still a going concern, eventually you're going to have some savings to put into the market. You have the ability to wait out a bear market and see stocks come back. Even if it does take the average of 26 months for stocks to come back, you have some time if you're younger to see that through. If you're older, in your later 50s or early 60s or 70s, and you're approaching retirement or you are retired, then that risk is much more real, where you better have some diversification to wait this out, and you better have a portfolio that will allow you to be durable enough to see it through, because you may not have as much time to wait things out. And even when you are retired, you may have 2 decades or 3 decades actually to watch your contributions grow if you're still putting money in before you retire. But you don't have that human capital component of the savings to help see you through. So if you're someone who's a net saver in the years ahead, you want the stock market to be down. As counterintuitive as that seems, you're buying at lower prices. If you're a young person, I am 38 years old. I know I still have plenty of time until I retire. It's painful to watch my current holdings go down, but I know every time I get a paycheck and it goes into my 401k, I'm buying at lower prices. For expected returns, that's a good thing. If I was closer to retirement, I would think much longer and harder about that in terms of what my balance is between safe, high quality asset and other ends. So I think you just have to be much more cognizant about your asset allocation when you're older and approaching or in retirement, because that's when you really have, these bear markets can be really painful. And I wonder if we're going to have a lot of older people who are going to be forced to either come back to the workforce or stay in the workforce longer than they expected, because their stock market portfolio is much lower than they expected.
Yeah, absolutely. And I think so, for example, like let's say if you have people, in their 50s and 60s right now, and they were maybe more on the heavy side in the markets, in equities, I should say, 80% or more possibly, what do they do? I mean, at this point, like, do
I
you
mean,
rebalance, or do you try to basically write this out?
the thing to remember is it's hard to not take that peak value of your stock market and say, well, in early February, my portfolio was worth X and now it's worth Y. And I'm going to constantly anchor to that value at X. And the stock market is constantly changing. And the hard thing for people to remember is we, over the long history of the market over the past 100 years or so, stocks have traded at all time highs, roughly 5% of all trading days. The inverse of that would mean 95% of the time you're trading in a drawdown, in a state of drawdown where you're not at an all time high. So
Mm-hmm.
trying to always anchor to some certain value in your stocks are always going to fluctuate and change, and that's not going to change. But I think the thing to remember, so the typical rule of thumb, and obviously this is different for everyone depending on your situation and your standard of living and your spending needs, they say you can take out roughly 4% of your portfolio, maybe 3%, some people have been saying, because interest rates are lower. So 3 to 4% of your portfolio to safely withdraw and still be okay over, call it a 30-year retirement.
Mm-hmm.
If you look at that in terms of bonds, if you have 20% in bonds, that would mean you have roughly 5 years worth of spending. So that would give you 5 years to ride it out where you're only spending down bonds and trying to wait for stocks to come back. Now, if you have 40% of your portfolio in bonds, now we're talking 10 years worth of spending, and I'm not including something like inflation here. This is a very back of the envelope calculation. So that's one way to think about it, and not just in terms of, what are my risk and return profile parameters, but what is my spending actually going to be, and how much can I theoretically take out of my portfolio that's going to supplement any other income, whether it's Social Security or rental properties or whatever it is.
Mm-hmm.
How much do I need for my portfolio to sustain my standard of living? And of course, the other thing that people are going to have to do probably potentially is cut back their standard of living, which I think for people being quarantined right now probably isn't that difficult if they've managed to hold on to their job. But I think that's a different way to look at your portfolio. And instead of just thinking about, well, how much return can I expect and what can I grow the value to, you think about it in terms of how much you're going to have to spend, especially when you're at or approaching retirement years. And that's a good way for young people to think about this too, in terms of what level do I need my portfolio to be when I do retire to make it so I can live off of this thing and not worry too much that a bear market is going to severely, take that away from me.
Yeah, and I think that's important to know that balancing is the key. But then when you talk about decreasing your standard of living, so let's say if everyone out there says, hey, I'm going to decrease my standard of living by 10-12% in the coming years or so, and then maybe for the next 24 months, but that's going to have a direct effect on the companies that you buy from. That's going to affect their earnings, and that's going to reduce the earnings that are out there, and that's going to affect the market returns also. So it's kind of like that correlation kind of follows all the way through and through.
Yeah, and I studied behavior, so I'm interested in seeing what the unintended consequences of these actions are going to be. I think it's hard to change decades and decades of the American consumer. So I'm hopeful that people will still get out and spend money. I don't know that everyone's going to just, because I think a certain subset of the population, it would have been really hard for them to ever plan for something as bad as this, where your
Mhm.
business is effectively shut down. So I think for a lot of people, they never would have been able to, frankly, save for a situation like this. If you have been, then you're obviously way ahead of the ball game, and you're doing good. So
Mhm.
so I think in that I'm hopeful that people, but you're right. It could be the case where it takes people a long time to get back to their prior behavior, and hopefully one of the things that people learn from this is, maybe a lot of the stuff that I thought I needed before in terms of material possessions and even traveling and stuff like this, maybe I don't need that stuff as much as I thought I did in terms of sustaining my lifestyle. So maybe that's a way that people can, cross some things off their list in terms of their standard of living right now, to realize, like, okay, I thought I was going to have to spend this much, but now maybe I realize I don't need it as much as I thought, and I can cut back a little bit, and that will help me see through as well.
Right. Yeah. And I think it's tricky because, back when this happened in 2008, 2009, from the financial market standpoint, I feel like more than half the people I talk to, they don't even remember, in the sense, like, they don't remember like their lifestyles getting affected. I mean, they just kind of went about their day, went to work,
Yeah.
getting a paycheck. I mean, yeah, there are obviously some industries that got hit a lot harder than others, but this is like such a unique situation because everything came to a halt. I mean,
Yeah.
you can talk to anyone
old,
out there and they're going to say, I know what coronavirus is. I know what's going on in the markets. I know what's going on in the economy.
Yeah, it's weird because we have this almost known unknown where in the past, even in the financial crisis, people still argue about what the actual reasons for it were. The subprime mortgage crisis and the real estate and this debt bubble. And there were so many moving parts that people still argue over what actually happened. This one, we know exactly what the reason is. And
Mm-hmm.
and I think that's what makes some people optimistic that once we can get past this, hopefully we can do better. And so in the global pandemic of 1918, I've been reading about that a little bit. It's hard to believe that we had World War II, which ran right into the global pandemic of 1918 and 1919. Obviously, things were way different back then. But just 2 or 3 short years later, we started the Roaring Twenties, which is one of the most innovative and booming decades that we've ever had. Of course, that ended in the Great Depression. So there's different, but still, it's amazing the human spirit and our ability to look past some of this stuff. But there's an old quote where it said, which I think is true, that a recession is when your neighbor loses their job, and a depression is when you lose yours. So I think a lot of this for people is really going to be personal, and so some people could be just fine if their job holds on and they continue to make income, or even if their income is down a little bit, they'll probably be fine. It'll be a little painful. They see their investment portfolio go down. But when things recover, they'll probably be okay. If you lost your job or you lost your business, for you, this, no matter if stocks fall as much as the depression or not, for you, it feels like a depression. So I think a lot of it is really just showing how personal this can be in the economy. Like we see these numbers of 6 million people file for unemployment, and these big statistics are hard to wrap your head around, but you have to realize that every one of those is an individual person or household or family. And so I think it hits people differently depending on their own circumstances and situations. So it these things really impact people differently depending on what happens to you.
Yeah. And it's kind of funny that just a few months ago, we do these polls in the groups and that kind of stuff and talk about, look, the market's been on a roar for the last 10 years or so. What's the next thing what's the next bubble that's going to be? And no one talked about coronavirus back then, obviously. But what we did talk about was student loans, the student loan bubble, or the trillions of dollars in student loans that are out there is just staggering. I mean, it's such a massive number. And we talked about that's going to be, that tipping point for the markets, that when those start to default, that's when you're going to see that big downturn in the economy. Now, no one's talking about that right now because we're all focused on the coronavirus. So I think what I worry about is going forward, what's going to happen to these student loans? I mean, what's going to happen to people that are not going to be able to make as much money, especially some of the healthcare professionals, med school, dental school. I mean, some loans out there are in excess of $500,000. And even some of these public universities, I mean, undergrad loans being over $100,000 easily nowadays. What's that bubble going to look like, 2, 3, 5 years out?
Yeah, I don't know if this, because they've obviously, and maybe you can tell, I don't know if your loans from dental school are part of this, where the Fed has put a moratorium on payments for the next 3 months.
Right.
That includes everyone.
It is, but that doesn't eliminate it,
Right.
And
Oh yeah, yeah.
If your ability to make money starts to go down, then that's going to have that effect also on the long-term implications of student loans.
I'm wondering if maybe I'm hopeful more than anything that this will be the first step in the political will to somehow put a dent in that somehow and help people a little bit, because they've shown they've taken the first step. But I agree, it's a huge number. It's been rising really, really fast. And one of the things people have always been told is that, well, if you get this education, your income will probably be higher than it would have otherwise. Mm-hmm. And I think this is still true. Of course, the numbers have now gone up where you're borrowing more than you ever did before. And if those incomes then don't back up those loans like they have in the past, then you're right. That's a really difficult situation. So now you have a double whammy of not only do you have the loans, but you're not getting the income that you were thought of to be promised. So it can certainly be a difficult situation, especially for young people who are just now coming and trying to get into the job market and pay those off as quickly as they can. So yeah. I agree that's something that hasn't gone away. And I think there are going to be a lot of problems like that people will try to push out for a few months or years because of this, that are still just not going away.
Yeah, and I think obviously, like I just read yesterday, they're already talking about phase four of this stimulus bill, um, and who knows what that's going to look like. I mean, from the from the economy standpoint, right? I think our GDP last year was about 21 trillion or so.
Yeah.
So this is already a good percentage of our GDP right now. What do you think, in your opinion, that max number could look like in terms of the stimulus? How many trillions are we talking about?
Yeah, it's hard to say. We're getting up to the point where the percentage of government spending to GDP from something like this is this year we're approaching World War II levels, which in a lot of ways this is maybe a war for us because we're fighting something that it's this unforeseen enemy. Um, but I think it obviously makes sense because the government has mandated that a lot of these businesses shut down because they're telling people to stay home, and
Hmm.
so I don't look at this as much of a stimulus plan as I do as a rescue plan, and it makes sense as a way to give everyone a bridge until we can hopefully get back and get things started again. So I hope that they continue to do as many as are necessary, depending on the length and severity of this crisis, because certain people are going to need to pay rent and buy necessities for themselves, especially those who have lost money. And luckily, they are helping people on the lower end of the income scale, probably the most from this. But there's people who have made decent money the last few years who are feeling pain as well, who their businesses are shut down as well. And just because they made decent money in the past doesn't mean that will carry forward into the future. So I think there's other people that are feeling the pain from this too. So I think there's hopefully as we go through this that they'll figure out other places to address and people to help.
Yeah, I agree. And like you just said, I mean, this is kind of more of a bridge to really just make sure the economy kind of keeps moving forward with some of this, so that everything doesn't just stay at this halt right now. It's going to be tricky. I mean, I feel like you know what we don't know is like when this is going to be over. Do we go back to work in May, June, July, or is this going to be one of those things like things we don't go back to work till September, or who knows, right? I think that's the trickiest part, is that there's no guidance, there's no data on when this will be over.
Yeah, and unfortunately, I think even the experts don't know, which makes it even harder for people to plan ahead. So, we spend a lot of our time talking to clients and the people that we are communicating to about the importance of long-term planning. But we
Mhm.
always say that the long term is not where life is lived. So you have to have these contingency plans and figure out a way to get through the short term to ever see the long term. And so for a
Right.
lot of people, unfortunately, people never want to admit this when they're experts, but a lot of it is just guessing, unfortunately, especially for even for the experts who just really don't know what's happening. So I, I think you have to again plan for a wide range of outcomes, and then as we hit certain milestones, then you update your priors based on what actually happened. And that's what we do with long-term financial plans is we tell people, hey, here's the expectations we're putting in for inflation and returns and what you're going to spend your money on. And then when we have our checkups with them on a quarterly or annual basis with our clients, we say, okay, here's what actually happened. And now let's see if that was better or worse than expected. And
Mhm.
did you spend the money you said you thought you were going to? Are your goals still the same? Do you still want to do everything you said you were going to do? Maybe things have changed in the last 5 years since you became a client, and now we need to update your plan. So I think people are going to have to think that way in terms of, all right, let's have some thoughts and expectations, and then update as reality hits, and then move on from there. But unfortunately,
Right.
a lot of it is guessing. But that's the only way you can really deal with these days, I guess.
Yeah, absolutely. And then kind of going back to the investing part of it, if you let's say people have this money saved up, and like you just said, now you're able to buy the market at a lot cheaper valuation than a month ago or so. At what point, I mean, would you tell your clients like, hey, let's double down on your weekly or bi-weekly or monthly investments?
It could. Again, I think a lot of it comes down to understanding what your time horizon is on this stuff. If you're
Yeah.
if you're trying to make money over 6 months or 9 months or 12 months, I I think anything is just a guess, and trying to predict the stock market over that amount of time frame is silly. So I think as long as you have a 3, 5, hopefully 10, 15 year time horizon, then I think the timing doesn't matter nearly as much. So there's things you can do. So if you have an asset allocation place and you talked about, well, let's say someone has 80% in stocks and 20% in bonds,
Hmm.
stocks are down so much, you're going to over rebalance. So, all right, I'm going to go to 85-15 because stocks are down so much. So I'm going to over rebalance a little bit. And then eventually when stocks recover, I'll get back to my place where I was more comfortable. So I think maybe that's a way that people can take a little more extra risk if they want to try to boost returns because they think stocks are going to do well in the future. I think that's one way to do it instead of trying to figure out exactly when to hit it. But if you wanted to, let's say you wanted to ramp up and do all your IRA contributions early, you could certainly do that, but just go through with the understanding that if you do it that early and you blow your wad, you could be sitting there later and say, oh, I could have gotten in at lower prices. So you just have to be willing to be happy with whatever decision that you make and not try to second guess yourself, because it's going to be really easy to second guess yourself a lot with this type of market.
Yeah. And if someone just asked this question about like, what are your thoughts on, some of these energy stocks and airlines and all these kind of things? Because some of these are down 75-80% at this point, right? But it's like you might also be catching a falling knife, because who knows, with consolidation, maybe some of these companies get bought out for pennies on the dollar and you would never see that money back.
Yeah, I think this is the kind of thing where, again, I would keep this more to my fun portfolio as opposed to my core holdings, because unfortunately, some stocks just really don't come back. So if you tried to pick through the rubble in the financial crisis and you wanted to buy Citigroup or AIG or some of these companies are still well below where even a company like GE right now is below where it was in the year 2000. And so there's a huge difference between an individual company and then the stock market at whole, because a lot of companies, they see these catastrophic returns and they don't come back. So if you're hoping, well, what if it just makes it back to even? I'm going to make a huge windfall on this. There's nothing that says that has to happen. So there certainly are going to be some areas where you're going to see huge returns, even if it doesn't go back to where it was. Some of the bounces in these stocks and these cruise ships and energy stocks are going to be huge, but I would be careful trying to be too extreme on any falling knife, because some of these stocks, frankly, just never come back and never get back to their peak to where they were.
So if you were to pick, let's say, individual stocks, right? And what kind of sectors, what kind of like groups would potentially do better in this kind of environment 6 to 12 months out, maybe even in your fund portfolio? So what kind of sectors do you think could do better moving forward?
See, I this is really tough to predict, but I think this is actually where something like an ETF can do you better than an individual stock, because ETFs now you can pick sectors and different industries and not have to bet on any one. So you could pick all integrated oil companies if you're looking to get an energy or just the energy ETF. So instead of trying to bottom pick the best one, maybe your range of outcomes in terms of gains won't be as big, but it gives you a little more diversification. So another way I think about this is people want to figure out, well, who are the biggest beaten down ones? But I want to say, like, is it possible that the winners going into this are going to be the winners coming out of it? So the fact that they have just this huge boatload of cash on their balance sheets, and they've all done much better than the market this year, actually, because they actually came into this thing so well. And a lot of people, you talked about looking for risks beforehand. A lot of people were worried. These companies have gotten so much bigger than the market. The top 5 companies in the S&P make up 18% of the market or something, and people were worried that's going to be the next shoe to drop. I'm not wondering if the winners are just going to get bigger from this, because there's going to be so much consolidation, because all the little players are going to go out of business and they're going to be either snap them up or they're going to go bankrupt. Right. So I wonder if the thing is not to look through the pile of losers, but what if we look for the winners and who's going to come out stronger from this? So I think there's 2 different ways to look at that. I'm not good at predicting those things, these sectors and that sort of thing. That's just not the way that that's just not what I'm good at. So I'll leave that to someone else, but I would also look, what's not going to change from this and who's going to get stronger. Yeah,
that's a good point. And of course, like, you've seen some stocks that have done well. I mean, especially a company like Zoom, but at the same time, like, you feel like from the valuation standpoint, it may not make sense. I mean, it's trading at such a high valuation right now, purely because of what's happening right now. But what happens maybe in 2 months, things are back to normal, all that. Is that going to drop off, where all these people are on Zoom and that's going to drop off potentially,
Right. Yeah. So, and someone asked, I see here on about the 3-time leverage. We actually talked to one of the guys from Direction on our podcast a couple weeks ago about these deals. And he talked about a lot of what happens with those 3-time levered ETFs, whether you're going long or short, depends on the volatility of the underlying market. And so even if you directionally pick things right, if stocks are more volatile because those things are resetting on a daily basis, you could actually do worse in one of those than what the direction that you picked is. So I think you have to be careful about investing in those and understand that the range of outcomes in those is not only dependent on the direction of the market, but how volatile they are. So
Yeah.
Those can certainly, those things worked pretty well for the 10-year bull market we had. If you were in a 3-time levered S&P 500, you did really, really well. You made like 30 to 40% a year. But those things are getting hammered now, and the volatility is not helping. So a lot of it depends on how long this volatility sticks with us for.
Right. Absolutely. Yeah, I was, I've been watching the markets behind you on the screen, and it's crazy how much volatility there is. It just keeps, changing like crazy. So yeah, I mean, I think, from the standpoint of what's going to happen in the future is obviously the unknown. No one knows that. But what you just talked about, some of these things it's going to help hugely because it gives us some direction on, kind of what to look for and what to do kind of going forward. Do you, and thanks so much again for coming on. We appreciate it so much. Do you have any other tips or comments for us, from your side?
I just think, again, I come back to the planning thing. I think even a subpar plan is better than no plan. So I think you just have to have some sort of plan. Write it on a piece of paper. It could be one page. If you don't have an investment plan or a financial plan in place, write something down. I think as long as you just have a plan, you're going to be far better off than the majority of investors, because those are the people that capitulate and sell at the bottom. After stocks are down 40%, they say, "Get me out. I want nothing to do with this," because they have no plan in place and no contingencies in place to see them through this. So I think you just have to have some sort of plan, even if it's a bad plan. I think the good strategy you can stick to is far superior to the great one that you can't stick with. So that's my only sort of parting advice, is just to have some sort of plan in place to guide your actions.
Sounds good. Awesome. Well, Ben, thanks so much for coming on. I may have to bug you again to kind of come back on at some point in the near future, and we'll go from there.
All right. Thanks very much.
Thank you. Take care.
Bye.